Hey folks, welcome back to the channel. Let's talk about the equity risk premium, what it is, and what it can tell us about the stock market's valuation. The risk premium is simply the difference between what the stock market is expected to return and the risk-free rate, or the government bond yield. Now, generally, you would expect the stock market to return higher than the risk-free rate. So the reason why this risk premium exists is because investors have to be compensated with more potential returns due to the risk that they're taking with the stock market, since that is typically more volatile than just holding a bond, especially if you hold it to maturity. There are times when the risk premium is very high, which is a good time to get into stocks because that's when interest rates are really low, but valuations for stocks are very favorable, so you get a big risk premium. Other times, the equity risk premium is lower, which means it's less favorable to invest in the stock market and maybe better to put more of your money in bonds, real estate, or other assets. So what is the risk premium for the market today? Well, to figure out the expected market return, all we have to do is take the inverse of the PE ratio. So I'm going to be using the forward PE ratio of the S&P 500 sourced from Yardeni's website. And as of right now, the forward PE is 19. So I'm going to take the inverse of that, which is 1 divided by 19. And that gives me about 5.3%. And that is the expected yield or return of the stock market over the next 12 months. And you can times that by 100 to get the percentage. So if the expected market return is 5%, what is the risk-free rate? Well, taking a look at CNBC's website, we can see the US 3-month Treasury is also at 5.3%. And the 1 year is at 5.3 as well. So the risk-free rate is also 5.3, which means the equity risk premium right now is basically sitting at 0, which is pretty low historically speaking. In fact, if we take a look at this chart from FT, we can see the dark blue line here is the stock market's earnings yield. So this is the 1 over PE ratio, which is what you would expect the market to return over the next 12 months. And over the last decade, you can see it's been chopping a bit, but mostly going down. And now it's sitting at pretty much 5.3 like we calculated. Meanwhile, this light blue line is the 3-month Treasury yield, which we just looked at, which is also 5.3%. And pretty much all of that gain just came from the last year when the Federal Reserve started to raise interest rates in early 2022. So because of that huge move up in the Treasury yield and a more modest drop in the S&P 500 forward earnings yield, the two are pretty much exactly in the same spot, which means the equity risk premium right now is virtually non-existent. So as an investor, why would you put money in the stock market just to earn a potential 5.3% when you can put it in a risk-free bond and get guaranteed 5.3%? You could make the argument that the stock market can return higher than 5.3 over the next year, which is possible. But with a recession likely just around the corner, earnings may fail to live up to expectations. And if that happens, then you may not get the 5.3% return from stocks that are expected if profitability expectations remain the same. So that's leading some people, like this article from Morgan Stanley, to caution against buying the US stock market right now. They mentioned that the equity risk premium is at a 20-year low, and it's probably better at this point for investors to put their money in yield and income generating assets instead of the stock market. So as you can see, most of the time the risk premium is quite wide. Over the last 10 years, the difference between the darker blue line on the top and the lighter blue line on the bottom, there's usually like a 3 or 4% spread there. It's just over the last year that the two has gotten really close together. However, if we expect the S&P 500 earnings yield to go back up to maybe 6%, which is closer to its historical average, then even then, as long as the risk-free rate, the Treasury yield, is still this high, it's just hard to make a compelling case to go 100% all into stocks. But we can try to figure out where the stock market should be if the 12-month forward earnings yield of the stock market went back up to 6%. So all we do is take the 12-month forward expected earnings, which I'm getting here from Yardeni's website again, and I'm going to take the 4 quarterly earnings by analyst consensus as of right now from Q3 this year until Q2 next year. So that's 4 quarters or 12 months of data. And this gives us a forward earnings of the S&P 500 as an index of $231. And if we expect this to be a 6% earnings yield, then we divide this number by 6%, and we get 3861. And what is the S&P 500 at today? 4,348. So you can see there is quite a big difference between where the stock market is right now and where it should be if valuations were more in line with historical patterns. But just because the overall index has a PE of 19, there are specific sectors or companies that are still relatively underpriced compared to what they are historically. So if we break up the S&P 500 into its individual sectors, we can see that specific industries that are bringing up the overall PE of the S&P 500 are very elevated. For example, healthcare right now, 16.8 times forward earnings, which is pretty high up there compared to the last 17 years. Information technology as well. As you can see from the last year, there was this incredible multiple expansion from below 20 to now at 27. Consumer discretionary, so this would be companies like Amazon, not ridiculously high, but still above average since 2006. But there are industries that are looking not too bad. For example, energy is only trading at a 10.4 times forward earnings. Financials as well, maybe not super cheap, but at 13 times earnings, that is quite reasonable. So the stock market works in cycles. It's good to keep in mind that just because you missed a huge rally doesn't mean you should go chasing after it. There's going to be a pullback at some point. Meanwhile, now is probably a good time to look at other alternative investments out there, like bonds or real estate, or yield and income generating assets, as Morgan Stanley says. Right now, just because the equity risk premium is very low, I would be cautious about investing in the stock market, which is why I haven't been investing too much into the market this year yet. But let's see where things go from here. If we do get a recession later this year or early next year, we may see the equity risk premium expand again, most likely due to the interest rate on the risk-free bond going down. So that's it for this video. Thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.